It wouldn't be Jackson Hole if I wasn't doing an interview without you.
Well, it's a delight.
It is. Well, I don't know how much of a delight it is for the Fed, though. Jay Powell's giving the traditional Fed chairman kicks it off Friday morning. People are putting a lot of weight on this speech. They want him to be clear about where they're going and where they are now. What is the challenge for Jay Powell?
Well, they want him to be clear, and clarity is the name of the game today. Because we have had so many changes during the past year, during the past decade, and now is the time to project clarity to the financial markets. And I believe that Jay Powell is perfectly capable to do that, and I expect him to do that. What we have is, we have inflation that is much above what anyone expected, and what we need to do is to break the back of it before it gets engraved into contracts, into wages, before it is deeper in the economy. The problem always is you have a relative price rise because of a shock, this one or another, and the challenge is to ensure that it is not spreading itself like a fire in a broad area. And this is where the Fed comes in, because the Federal Reserve, like all central banks, the main mission is price stability. And the main strategy is anticipatory. You need to be ahead of the curve, and therefore the Fed has been a little bit behind the curve. This is the time to both project that you are committed to deal with the inflation, but also demonstrate it not in words but in actions, and they have done it up to now.
Well, in terms of how they got from anticipatory to looking at transitory inflation, what happened there? Is that something else that Jay Powell has to address in this speech?
Well, I think that the focus on transitory versus permanent has been misplaced, because the issue is we are not observers of a flow of information and say this is temporary or this is permanent, and only if it is permanent we act. I think that the role of the Federal Reserve and of central banks is to ensure that shocks that can become permanent are actually becoming temporary, and the action of the Fed can ensure that this will happen.
One of the issues for Jay Powell and his colleagues is that markets just don't seem to quite believe the Fed is ready to do this. Maybe bond yields rise for a while, but then they rally again. Is it a lack of credibility? Is it bad communication? Is it just going to be harder now that inflation got out of control to convince people that they can get the job done now?
Well, we are now in a very unique situation where many of the shocks are new. They're all coming at the same time. We have energy, we have pandemic, we have supply chain, we have a war, we have food. Some things that the Fed can do very little about. And what the Fed has to ensure is that it does not create a spiral that is hurting credibility and hurting stability. And I think that this is why the Fed needs to be now much more front-loading than before, so as to ensure that you are coming ahead of the curve. And I would not worry about overshooting with interest rates for a while to build up credibility, to reduce the lagging behind of what you have been, because you have been a little bit lagging behind. This is the time to accelerate, like in a convoy.
Okay.
When you are put behind, press on the gas, go to where you want to be, and start cruising at the pace that you want. So I will not be averse to more dramatic actions in order to ensure that next year, when we talk, we will speak about the inflation that was, the inflation that the Fed prevented from spreading.
How aggressive is too aggressive, though, Jacob? Because we spoke with Joseph Stiglitz this week, and he said the risk you run is that you actually exacerbate inflationary pressures if you move with too steep and too long and too aggressive this rate hiking cycle, I should say, because that disincentivizes the investment needed to solve the supply chain snarls. Do you think there's a good reason to that argument?
Well, I think that given the risk-reward situation of the present, I think that the greater risk is losing the fight against inflation. And this is the time to build the credibility and move forward. In fact, markets will welcome a signal that says, I'm going to ensure price stability. Look, we are now at interest rates that are clearly below what they should be in the medium term. When inflation is so high, real interest rates is so negative today that I would not worry about the debate of 0.25%, 0.5%, 0.75%. The reality is that even if you go 0.75%, you will have still a distance to go before you bring the stance of monetary policy to neutral. Remember, it's not only interest rates. We have had a very massive expansion of the balance sheets of the Federal Reserve and of other central banks. And we have had also huge stimulus that has been injected into the economies. When you put all of it together, I think that the balance of risk today is more inflation rather than less inflation.
How closely are you watching China when it's been such an engine of global growth over the past decades? Do we need to be more concerned that the new normal of slower growth is going to be a global drag as well?
Well, China is the most serious issue. The world can grow without Russia. The world cannot grow without China. China is the biggest trading partner of every part of the world. We have seen the extraordinary havoc of supply chain, of what happens when China is stepping out of the situation. And therefore, I think that normalization of the relations with China and ensuring the ongoing economic and financial relationships is key. The fact is that China's growth, as you have indicated, is going to be much lower than what it has been in the previous decades, and not marginally so, much lower. And therefore it is important that the world is not adding to this stress, but rather accommodating it and making sure that China stays an integral part of the world economic system.
Final question. Can the Federal Reserve avoid recession? Is it going to have to push so hard that that does become likely now? And that's what they have to do, and that's what markets need to hear.
Well, that's why the challenge is so big, because the shocks to the economy that create downside risks, whether it is the energy, whether it is the supply chain, whether it is the food, whether it is any of those things that we were talking about, are to the downside. And therefore, yes, there are now built-in slowdown or recessionary tendencies. Let me only say that inflation will not solve the problem. Inflation will only add to the challenge. And therefore, I would not even start thinking about trade-offs. Why don't you give up a little bit on the inflation because we need growth? It has never worked. And you know what? There was a central bank from the Bundesbank president, Ottmar Eminger, once said, if you flirt with inflation, you end up marrying it. So we really don't want to get married to the inflation. We need now to ensure that the world's stability is maintained. This is the key for growth.